Excellent. Good afternoon, everyone. This is Jerry Winter with Photon Trading Services. We are joined today by trading systems developer and author John Ehlers. I want to first of all thank everybody for taking the time to spend with us this afternoon, and certainly John for taking the time to chat with us again. During today's presentation, we're going to talk a little bit more about the relationship that cycles have to the markets. John's also going to tell us about his upcoming workshop and discuss what will be going on there. Here's our standard NFA disclaimer. Risk of trading commodities or futures can be substantial. Potential risks in addition to potential rewards certainly has to be kept in mind, making sure that any investing or trading that you do is within your means. I'm sure that most of you that are listening to the webinar had some experience with Mr. Ehlers. There's his picture right there. I've known John for over 15 years now, going back to the early days of investors utilizing personal computers to implement trading systems. John was one of the early adopters of this technology and applying that to the markets, and especially on a retail level, which is what we're most interested in and the folks I deal with. Why don't we start, John? Good afternoon.
Hi, Jerry. Thank you, and hello to everyone.
Hi, John. I'm very glad that you had the time to spend with us today. First of all, why don't you tell us a little bit about your background? I know you've had somewhat of an unusual route to getting to where you are, and I'm sure everyone will be kind of interested in hearing the backstory there.
Be happy to, Jerry. I am an electrical engineer trained in information theory and wave propagation. And I got into trading because I got a bonus back in the late 1970s. And when I started trading, I noticed that Wells Wilder had just developed the RSI. And the first question I asked was, why does he use 14 days in his RSI? And the best answer I got was because that's the way he wrote the indicator. And that was not satisfying to me. And so I began to search for different ways to get the right length of data to find the best way to use the indicator. And about that same time, I attended a seminar and found out about MESA, that's Maximum Entropy Spectrum Analysis. It was being used at that time for exploration for oil and trying to find the return echo information in the return echoes from seismic exploration. And I knew that was an ideal methodology to use for trading because the cycles in the market are so short-term and they're continuously changing. So I not only used that for my own trading, but I started to write about it a little bit. And before I knew it, I became a vendor. And I continued my research into the use of cycles in the market up to where we are today.
Excellent. You're doing a workshop, and that's part of what we're going to talk about today. Key behind this, in my opinion, is that you're bringing traders together, in this case, in your backyard near Cambria, California. Can you give us some sort of introduction to this workshop, go into some of the details, and maybe what some of the attendees can expect if they should decide to come visit?
Sure. First and foremost, this is a workshop for traders. It's not for mathematicians and scientists. It's a way to use the information technology to trade the markets. And what I want to share is all of my research over the past 40 plus years and how I use it in my own trading. A lot of it is more complicated that can be related in a book or a magazine article, but that's why I generated this 3-day intensive learning workshop, one-on-one, so it's an intimate learning experience. And what I'm going to be covering is the way the data is structured in the market. Market data is pretty noisy, and so we have to recognize that up front, but it does have certain characteristics that we can use. And to use it, we need digital signal processing techniques, but not all of that. There's a certain subset that's fairly simple that is useful for traders. And in the process of using DSP techniques, we'll create some indicators that really indicate things and not lead you astray. And in the process of using those indicators, we'll develop robust trading strategies, those that work into the future, not just in the past, both on daily bars for position trading as well as intraday trading strategies.
You've given us an example of kind of the syllabus here, and the first, you just on it briefly a minute ago, the information about the data, things that you've talked about before. This probably isn't random. The data is first module. You put it there first because of its importance to what you do. All these other things that we see are a function of data.
Right.
And how do you evaluate? Are these other factors here? Is this what you use to evaluate the data, or is this a result of the data?
Of the data, what how it's described, and how to use it and how to attack it from a scientific perspective. First of all, I want to talk about theory. A filter is an easy thing to describe. It has an input and an output. And the ratio between the input and the output is a transfer response. So I'll talk about this transfer response in a mathematical sense. And the one way to describe it is through the use of Z-transforms. Z-transforms can easily be translated into code, such as easy language. And that's how we will approach the theory of filters.
And here we've got a list of some of the filters and the indicators. Are these things that, have you created all of these, or are these kind of in the market, and do you use all of these or some of these to create the strategies that you're talking about, and how do you use these to predict things?
Well, I first of all describe what filters are. There are finite impulse response filters, and that's a certain class of filter, which is different from infinite impulse response filters. And I try to make the comparison of which are useful for traders. And from those general classes, we develop specific filters. I have invented the super smoother and the roofing filter. I've also been able to translate from analog filters, the bandpass filters. I've designed a Filt 1.1 technique, which is kind of a class of an error correcting codes, and we'll get into error correcting codes that are useful, particularly in trading. And it's also useful to normalize the swings of your oscillator indicators. And so I use an automatic gain control. That's kind of a circuit that's pulled out of a radio, actually. And so we use it to maintain a constant amplitude, so you know whether what your indicator is showing regarding whether you're trading Apple or index futures or Forex. They all come out to have the same indicator look and feel. That's helpful for trading. And finally, I'll talk about transforms, how to change the shape of your indicators so that they can better serve you to do what you want to do.
And again, in the past, you've spent quite a bit of time on cycles, and I would imagine that that's one of the things that you feel is most important about evaluating markets, kind of a common theme in all of the different books that you've written and the papers that you've published. How did you determine that cycles were important and that they can be used to determine direction of the market? What brought you to that conclusion?
Well, even a casual observer of market charts can see the cycles that are embedded there. And the problem is that they're frustrating in anyone's ability to use them. First thing you have to be able to do is to measure what is apparently obvious to the casual observer. And to do that, I've developed the MESA, maximum entropy spectrum analysis approach. And then I compare it to discrete Fourier transform, which I really don't, is not one of my favorites. But I do like autocorrelation periodogram because that avoids some of the problems associated with market data, the fractal nature of market data. By doing the autocorrelation, you get rid of problems associated with the fractal structure. Some of the other techniques listed here are not the best things to use for market cycle measurements, but I wanted to include them to show why they are not good. And so it's often in an educational environment, often better to show what doesn't work as well as what showing is what does work.
So once you've measured the cycles, is that pretty much the first step in terms of creating a strategy?
We have to be knowledgeable about what's in the strategy, and it basically comes from indicators and knowing how the indicators are going to react to the market data. And so that gets into describing strategies in terms of what are the key parameters to deal with. You also, in dealing with strategies, you have to know a little bit about statistics and to calibrate your expectation of what you can get from a trading system. You can't win them all, and you have to accept the fact that you can only get a certain percentage of winners. But when you go into parameter optimization, it's a kind of full of landmines because you can fool yourself just looking at getting so-called optimization in history. You're picking the best combination of things that used to work, but that's no guarantee that they're going to work into the future. And so that introduces the whole subject of robustness. What makes a strategy robust so that you have confidence going to work into the future? And that means working with statistics like Monte Carlo simulation. Here you see the bell curve of probable profits taken over a huge number of trades, something like 50,000 trades. And these, of course, are simulated trades, but it gives you the statistics of what you can expect from your trading strategy. And not the least of what causes problems or can be used in your benefit is the knowledge of how the signal to noise ratio is behaving. If you have good signal, that's a better and more opportune time to trade than when you don't, relative to the noise.
I'm sure someone that is considering going to the workshop wants to know what kinds of things are they going to be receiving, what kind of knowledge are they going to get. And so you've got a list here of some unpublished trading strategies, and I would assume this is a culmination of what we've kind of gone over and you've put together and created these functional programs that they can utilize.
Yes, this is explicit code. The Mesa Phaser is a product that I sell. It happens to be a $3,000 product. And so coming to the website, you're going to get that code fully disclosed. And all of these others are explicit trading strategy that have been robust in the long haul. These are specific different implementations of strategies, and attendees will be able to leave the workshop with this code, being able to start trading on the next Monday morning if they want.
You've got a specific title there on daily bars, and our next slide is going to be talking about the intraday strategies. What kind of differences are there, and is your particular technique and methodology, does it work as well on both types of time frames? And in general, do day trading strategies have as good a success as what we call swing trading?
They trade differently, much differently. And the big difference is that every day is a new day. And so you're starting from scratch on both from your capital point of view and from your trading strategy point of view. There are oftentimes difficulties in trading that due to gaps, and there has to be a continuity from day to day that has to be considered. So that throws some different considerations. Measure, I would quantify the difference as follows. When you're trading on daily bars, you're holding positions for perhaps half a cycle, and there's largely a 1 month cycle. So you're holding positions on the order of 2 weeks. So your risk is higher over a 2-week period than it is on an intraday. On an intraday, you're out of the market overnight. And simply from a risk-reward perspective, you're going to have a higher reward trading daily bars. Your risk is higher, your reward is higher. However, going intraday, the margin is much less, and the problem of having margin calls is severely reduced because of reduced margin and because you can take each new day, take a new look on each day. On the other hand, it takes a different look at the technology to attack that daily, the market data that's available to you every day. So they're distinctly different processes in my mind. But attendees will be able to lead with a number of strategies. These are strategies that I trade and have traded in my own account.
So the takeaway here is that the individual trader kind of has to know himself to a certain extent and what kind of scenario he's more comfortable with. Is he more comfortable in holding positions overnight and looking for a higher risk reward kind of structure, or if they're more of a day trader and they have the time and resources to spend these shorter term strategies?
Correct. We try. The objective of the workshop is to give the tools to the trader that he can find useful. He may have one outlook today, but next month he may change his mind and have another outlook. So we're trying to give the technology perspective so he can move forward in his own trading life at a much greater rate than he could if he had to learn this by himself.
In that same vein, obviously, the people that will attend this are those who want to learn how to trade and do it themselves. Can you give us a little bit more of an idea of who would benefit the most from this particular workshop, and what would they need to know coming into the weekend?
Well, I think it's primarily aimed at the private trader, the self-directed trader who wants to trade for himself. Certainly CTAs that are trading for other folks are invited to come as well to use this technology for more people's advantage. I have a little bit of a reputation of being complicated in my approach. I try not to do that. This workshop is really aimed at traders and trying to transfer information that will be useful for traders. So I'm not going to get into complicated mathematics. If a trader has high school algebra and high school trigonometry, that should be adequate to know everything there is to know about how to use this information I'm going to share.
I've also got the takeaways here, and I think to that end, we are going to be providing some additional webinars in the series that will go over some of the mathematics and some of the technical aspects. So someone that's considering participating in this live doesn't necessarily need to be worried about that, because we will be providing some information prior that I think will get them on the ground running and will give them a good foundation for your presentation and what they're going to be seeing over the course of the 3 days. So the takeaways here, you've given us a couple of things that, again, I think a lot of people are asking, what am I going to get that I can put into a practical application in a relatively short period of time? And you've given us some idea here.
One of the favorite things that came from last year's workshop was one of the attendees said there were lots of aha moments. And that meant that these things that we all know and talk about came together and clicked. That's a takeaway. That's great.
You've given us kind of an incentive here. This is one of your publications that people can take a look at on Amazon. And if they do attend the workshop, this is something that you're going to be offering to them as well.
Absolutely. It's a $135 copy of the book. It includes code. Some of the indicators I'll be talking about in the workshop are in the book.
Last slide here kind of gives the who, what, where, when, how. If you want to just give us a couple of minutes, we've got the information to get hold of you. I am sure you're welcome, folks, to send you an email if they have further interest or they have questions, specifics. They can get hold of you, and you'd be more than happy to give them some details.
Absolutely. This is a screenshot from my website, mesasoftware.com. You can just go to the homepage and reach it by just scrolling down on the homepage. But if they have any questions, there's my email. Just give me a shout out, and I'd be happy to talk with you and answer any questions that you might have.
Perfect. That's about all we've got today. I just wanted to mention I had the privilege to attend last year's workshop. and it was an amazing experience. And personally, one of the most important parts was being able to spend 3 days plus with a group of traders on a very high level and being able to interact with them and exchange ideas and information and maybe techniques that you wouldn't have an opportunity to do anywhere else. I've been to hundreds, and you have too, probably, of seminars and trade shows and that kind of thing. To me, this was quite different. Can you just kind of give us your ideas and your feelings on last year and how that interaction is beneficial to a trader?
The truth is, I learned something last year. I learned, for example, a different way to measure robustness that I had never recognized before. That was contributed by one of the attendees. So I'm not the only way that the attendees will learn. They'll learn from each other. And after the workshop has concluded, I know many of the attendees have maintained contact with each other, and so they've learned to talk on a common language, and so they're able to interact and help each other also. So I think that's all beneficial.
And you also do have some follow-up sessions online, kind of a Google group that get together, because there's a lot of information that's provided in a relatively short period of time, but you do have some continuing support, and the group does continue to get together well after the end of the workshop.
Right. That's a really nice benefit for everyone, I think.
Well, excellent. Well, John, thank you very much. I really appreciate your time, and just want to let everybody know that this is a fantastic opportunity. You did one last year. We've got one planned this year. We may not know if this is going to continue on a yearly basis or not, so probably would want to take advantage of this opportunity while you still can. I'm going to put John's information back up on the screen here. Like I said, you can certainly give me a call. My phone number will be in the email, and you can certainly send John an email if you have any further questions or would like some information. John, thank you very much, and we'll look forward to talking to you again.
Okay, Jerry. Thank you very much.